Hey everybody, good to be here today. Time for Advanced Options. We do this each Friday, and I'm just glad you're here. You know, we've just gone through this long series in this class of different options strategies. We did, I can't remember, a dozen of them, I think. This week we're past that series, and I want to talk about kind of putting it together in terms of choosing an option strategy that's ideal for whatever trade you want. So we'll go, there's pros and cons, and I don't want to oversimplify it, but I want to give you some guidelines on it as well. So we're going to do that next. Also, let me just mention this. I got Mike Fairborn joining me in the chat today. That's great. Wonderful treat. He is familiar with all we're talking about today. I've been working with Mike for about 20 years now. So it's been a good experience. I've learned a lot from Mike over the years. Make sure you check him out on X, as well as my own account on X as well, at Brent Moore CS, at Mike Fairborn CS. He put those handles, X handles, in the chat for us as well. As I appreciate you there, Mike, on that. And let's go through the disclosures here real quick. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not a recommendation and or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. And the paper money software application is provided for educational purposes only. For the sake of simplicity, the examples in this presentation do not take into account commissions and fees. Just realize those are a thing you need to consider. Past performance of any security or strategy does not guarantee future results or success, and short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And there's no guarantee that execution of a stop order will be at or near the stop price. There we go. Okay, so we are going to talk about Greeks a little bit today, folks. Yes, we are. Indeed, I see some of that in the chat. I see some familiar names in the chat. And yeah, you know, Mike is a great photographer. Those of you not in the chat, there was a comment on that. A lot of times he'll take his bike out, go biking in the mountains, mountain biking up high in the mountains, and take some good photos there. So that's great. This is the S&P 500. Where are we at? We're down a little bit today. Not much. I mean, this market is like the little engine that could. And even when there's a lot of uncertainty and coming out, a lot of questionable data that people that supposedly you'd expect maybe would spook the market a little bit, the market keeps going. We're going to talk more about that in the next session coming up at the top of the hour, the next hour, that is, in Market Movers. I'll be doing that one as well. I'll be working with Mike. Mike's doing like a marathon chat session today, by the way, everybody. So how do we choose what strategy we're going to use? Well, some of it is going to come down to Greeks. And so what I want to do with you today is I want to just kind of go through some strategies and talk about the Greeks and the implications for the trades in terms of trying to help you decide which strategy is going to be appropriate for you, okay? Now, just realize, I'm not listing every strategy out there. I got to limit it somewhere because we could go on all day otherwise. So I still have, what, 15 strategies here or something like that. So we're going to go through those and just realize there's not going to be a perfect one-to-one correlation between strategy and you know, what the setup is and what the strategy is. Sometimes there's more than one strategy that'll fit the bill, and I just can't give you exactly which one, you know, a trader would use here on that. So just be aware of that. Okay. Let's just start. I'm going to start simple. We'll get a little more complex. And I'm going to just talk about each of these, and I'm going to go fairly quickly, and then we'll go to example trades here on this. Now, I cannot send you out this chart. Not allowed to, but I'm not stopping you from taking notes, folks, from doing screenshots or whatever you want to do here on this. Okay. So long calls. Oh, by the way, before I get into this, I mentioned that series that I've done on various strategies. And so you just go to the playlist if you want it. I'm going to put that playlist in the chat if you're interested, if you're watching live. If you're not watching live, if you're watching on recording, just go to the channel. You're on the Trader Talk Schwab Coaching channel. Go there, click on the playlist link. You'll see different classes. You can go to this class, pull up the playlist for it, and you'll see those different strategies listed. Okay, now, oh, by the way, everybody, I didn't even realize, I didn't see you immediately. Santa Clara, we have a live workshop tuning in today from Santa Clara, California, and I just want to welcome you here. I know that you guys are all eager to learn, and I would just encourage you to check out our webcasts each week, each day throughout the day, and hopefully you continue your learning journey there. So it's great to see you join us from Santa Clara, and the rest of you, look out in those in your area, in the big city near you, look at our schedule and see for future live workshops. People find them very, very helpful. So glad you can join us here. Okay, so let's talk about these strategies. Let's talk about the Greeks here on these strategies. Long calls, what are we going to call? I'm going to call this delta, and I'm going to say, yes, it's a positive delta. It's very bullish. Delta just means, are we bullish on this trade? And I didn't mean to do that. We're going to do that. And I put 2 plus signs there on this one because our deltas, typically it's quite a bullish trade. When we start getting into spreads, it still may be positive delta or negative delta, but the delta is not going to be as significant. Long calls are just kind of unabashedly bullish in that regard. All right. Now, what about theta? Well, one of the downsides on long calls is time decay works against you. Theta is the Greek that tells us all about time decay. So how does time decay affect it? Well, I'm going to put 2 negative signs there on that because time decay really can eat into those options there. Those long calls those long calls to theta can eat into those. Or Vega, how does implied volatility affect it? Well, implied volatility can certainly affect it pretty significantly. So Vega tells us how much the implied volatility is going to affect the trade. In other words, with Vega, if implied volatility goes up, does it help the trade or hurt the trade? Well, in the case of long calls, increases in implied volatility are going to help that trade. They're positive Vega trades. So there we go. Now I put a comment column there. I may add some comments on some of these. I don't know. I think, this is an advanced options class. I'm assuming you have some basic options knowledge here on these strategies. I'm going to assume you know maybe some of the basics of a long call here on this. All right. So let's talk about long puts. How do they differ from long calls? Well, number one, they're bearish. They're not bullish, and they can be quite bearish. That's why I put 2 negative signs on there. But they do share some commonalities with long calls. They're theta negative. Time decay is going to eat into those long puts in a significant way. So long calls, long puts, any long single option is going to have time decay working against you. And when we start to get to spreads, by the way, spread trades, really a lot of them are going to be which leg of the spread is the most impactful. Often that's the one that's closest to the money, the long put, or if it's a short put or whatever. So here's our theta on that. What about Vega? Well, similar to a long call, a long put has positive Vega. In other words, implied volatilities, increases in implied volatilities. Often that will come before an earnings event. If there's more uncertainty in the market, a lot of times, more fear in the market, a lot of times implied volatilities will go up. Long puts will benefit from those. That's what our long Vega is on that. Okay. Now, short calls, you know what? It's just basically going to be opposite long calls. So what I'm going to say is short calls are, hey, they're bearish. Okay. Oops. What did I just do? Okay. Short calls are bearish. Time decay, hey, that's why, well, at least one good reason why people do short options is they like the positive time decay. In other words, every day that ticks by, everything else being equal, okay, the stock may go up or down, but if we kind of extract that from the equation, the time decay, it benefits us in the case of short calls. Implied volatilities, increase in implied volatility would tend to hurt the trade. Decrease in implied volatilities would tend to help the trade. Now notice something here. Theta and vega are opposite. Theta and vega are opposite. Theta and vega are opposite. You're going to notice that quite a bit here today. Theta and vega are opposite in terms of the sign on those. Now, Myron says the VIX goes up, vega goes up too. So let's talk about this for a second, okay? So the VIX is a measure of implied volatilities on the S&P 500. So it's something to know. The VIX, because you'll hear about the VIX, okay? Most of you have probably even heard of the VIX at some point. It's a measure of implied volatility on S&P, on the S&P 500. Keep in mind, there's implied volatilities on individual options as well. And they don't necessarily go hand in hand with what the VIX is doing. You can have a stock where the implied volatility changes significantly and the VIX is just kind of sitting there humming along doing nothing, okay? And so don't confuse those. Now, also don't confuse, vega is a measure of how much the trade is going to be affected by changes in implied volatility. So let's say IVs go up significantly. Okay, IVs go up. Our vega may, that just tells us how much those IVs going up are going to affect the trade. So I wouldn't say vega goes up because IVs go up. What I would say is if IVs go up or down, the vega tells us how it's going to affect the trade. Okay? All right. So let's continue on with our thing. Good questions, by the way. I appreciate those. Okay, let's go to short put. Well, short puts are bullish. So we're going to do that. Short puts are bullish. And I'm just talking about single short puts or single short calls. Sometimes we don't do those short calls. And why not? Because naked calls, which is what we would call just a single short call. If it's not part of a spread and if you don't have the stock, we'd call it a naked call. Okay? They have unlimited risk. Okay? Naked calls have unlimited risk. And that's not a thing that a lot of people try and avoid that. That's why we don't just see a lot of naked calls out there. Short puts, time decay helps us out on those though. That's a good thing. That's one reason why people like naked short puts. And vega, same. Notice the similarities, by the way, with short calls and short puts. Pretty similar in a lot of respects. The delta is different on those. The delta is different on those. And, but theta positive, vega negative. Now, so those are kind of the easy ones. Long call verticals. Now you'll notice on some of these, I put in little parentheses next to them, ATM at the money or OTM out of the money. And the reason is this. The Greeks for spreads depend on what strike prices you choose. For example, on a long call vertical, I have a long call and I have a short call. Okay. Do they completely offset each other? Well, maybe not completely, but they can partially offset each other. And the magnitude of each of these values just depends on where the stock is in relationship where the strike price is, okay? And so if they're at the money, typically, for example, your theta is going to be highest when they're at the money contracts, all right? That's just an example there. And so the strike prices matter. The reason why I put at the money or out of the money on these is this is the typical setup that we teach on these. Can you do a long call vertical out of the money totally? You can, but more often than not, or can we do a short call vertical in the money? You could, but typically that's not how I'm going to teach those. And that's why, because I can't go through every scenario, or I'm going to go through the most common scenarios. Now, long call verticals, if it's at the money, what I mean by that is, obviously there's two different strikes. They both can't be exactly at the money. But if the stock is roughly in the middle between where your long call is and your short call, then the Greeks are probably going to largely offset each other in terms of theta, for example. Therefore, when I talk about Greeks on these, long call vertical, and I talk about theta, what I'm going to say is, it's pretty neutral. I'm going to put an equal sign for neutral on this. Theta is not going to probably, now, it's probably not going to be exactly neutral, but they'll be very largely offset with one another on theta and vega. And so I'm just going to say it's mostly neutral. That equal sign means mostly neutral. Delta, long call verticals, it's positive. However, notice I'm not putting two pluses there. And for a long put vertical, it's negative. It's bearish. Notice I'm not putting two minuses there because it's less positive. A long call vertical is reducing the delta versus just a straight long call. Same thing with long put verticals there. All right? Okay. Short call verticals. Well, what is that? That's a bearish trade. A short call vertical is a bearish trade. It's less bearish than just a short call because we have two legs on that again. Same thing with short put vertical. It's bullish, but I'm only putting one sign in there because it's less bullish or bearish. Theta, these are out of the money. When these are out of the money, and this is important to specify because if they were not out of the money, this may not be true. But if they're out of the money, the theta is going to be positive on those. That is one reason why these are popular trades often. And that the theta is, time decay helps you out on those trades. Vega, opposite sign there on that. But I'm just going to write in my note, often high prob. Okay, often high prob. Let me just change my formatting here on that so you can see that. Now, why doesn't everybody just always do that trade if they're high probability trades? Well, because like who's against high probability? Everybody wants high probability, of course, but there's a downside to it. Lower reward to risk. Okay, that's the price you pay, so to speak, for the high probability is the lower reward to risk. There's always this balancing act there in our trading. So as you're going through this, now let's keep on going through. Calendars, they can be, whether this is call calendars or put calendars, that's the C or the P. Delta is going to be, it just depends where the strike is in relationship to the stock price. If the strike price is above where the stock is, they're more bullish. If the price is below where the stock is, they're more bearish. In other words, the goal on these trades is you want the stock to go wherever the strike price is, essentially on that. So I'm saying it's neutral because very often we do them pretty neutral. It'll probably be slightly positive or slightly negative. And even if you started out on slightly neutral, wait a day and it'd probably look something different than that. Okay. What is our time decay on calendar spreads? What's our time decay on long calendars? Well, generally positive time decay on those, okay? Because we're selling the shorter term expiration. And that shorter term expiration is the one that's going to have the higher theta typically. Therefore, that's the one that's going to win out. And then Vega, typically positive. Let me get my control key on there. Typically positive on our Vega there on our calendar spreads. Okay, so iron condors. I got to say, a lot of the same stuff on iron condors as I did on calendars in terms of delta. We're going to call those neutral trades. They can be more bullish or bearish, depends where the stock is in relationship to the strike price, but basically you want the stock to stay in between our strikes, between the short call and the short put in terms of those spreads. An iron condor, a short iron condor is you're selling a call vertical, you're selling a put vertical, you want the stock to stay kind of in between those. That's where we're coming up with that delta neutral. Of course, that can change. Iron condors. Now, one way to think about this is this. A short R condor is just a short call vertical and a short put vertical. So in terms of the Greeks, look, if I have a negative and a plus, I'm going to call it kind of neutral. If I have a plus and a plus, that it's a positive time decay on that. That's a nice deal on that. Let me just do plus here. Okay. Vega, negative, negative. We end up with a negative Vega. Oops. Negative Vega on those. All right. So think about the implications of this. Of course, everybody always wants time decay to be working on our side on that. So yeah, it's nice to have that positive theta on things. But sometimes you can't have it. Because, like, for example, if I want a more leveraged type trade, okay, say a long call, I got to give up on that theta. The trade with more potential, maybe I shouldn't say more leveraged trade, it's the trade with more reward potential on it, then I may have to give up on the theta end of things. Vega, well, we may look at things like, someone mentioned earlier, the VIX or the implied volatility of the specific option as trying to help us decide which one of these, which strategy that we're going to use. So I want to finish off this table here before too long because I want to look at some more practical examples on this here. But let's see, what do we got? Long butterflies. Okay, so I feel like a broken record. Long butterflies. We want the stock to end up where the strike price is on those butterflies there on this. Okay, so I'm going to say neutral. Just depends where the stock is in relationship to the strike price. Time decay. That's going to benefit us again. So a lot of these strategies where a lot of traders like to maximize time decay. So we're seeing a lot of positive theta here. Our Vega negative on these. I'm going to say next to butterflies though, often lower probability. Okay, that's not a universal truth necessarily, depending on how you set it up, but that's just been my experience. Often those long butterflies are lower probability. Now I don't have these on here, but when you skew when you skew a butterfly, we can often shift that probability. Okay, we can often shift that probability on those, but that's one reason, maybe a little less, I don't know, maybe a little less popular, just a straight up butterfly, whereas a lot of times we'll skew those here. Long straddle. Long straddle is buying a call and buying a put at the same time. The delta, so buying call, buying put at the same time, it's basically gonna, it's kind of weird because you may say, well, do these cancel each other out? No, not really. We want it, I don't even know how to denote this. It's either, you want it to either be very positive or very negative in the case of a long straddle. You want it to go way up or way down. What you don't want is it to sit put, sit close to where it's at. That's a long straddle. Time decay, though, is definitely working against us on those long straddles, no doubt. And Vega is definitely helping us out on those long straddles. Okay, long call diagonal spreads. Okay, so these are kind of similar to calendars. A long call diagonal is going to be more bullish. It's more directional. It's kind of like a calendar, but it's directional. A long put diagonal, it's going to be bearish. It's directional, kind of like a calendar, but directional. Is it as bullish or bearish as, say, a long call or long put? No, which is why I'm only putting one plus or minus in there. And on that, our theta, we're going to say positive theta on those. Try that again. Positive theta on the put. Vega, negative. Vega, negative. All right. Um, like calendar, but directional. Okay. So let me do this and this and this and this, and then let me just format these so you can see what I wrote down. There you go. Okay. By the way, there's a survey link in the chat, everybody. So we appreciate you filling out that survey. Long synthetic. Well, let's kind of build a long synthetic. We're going to do a long call and a short put, delta positive, delta positive. Yes, a long synthetic is trying, it's not exactly going to do so, but it's trying to kind of mimic the price action of a stock. Of course, there's a Of course, there is there are some differences. Options expire, stocks don't expire. Stocks pay dividends often, not always. Stocks pay dividends. Options don't pay dividends. Okay, let me just oh, come on. I did this ahead of time because I'm oh, number, general. I just want text there. Then it should let me put that in there. Okay, so long synthetic is positive. There you go. Theta, there's the long call and the short put largely offset each other. So our Greeks are going to be minimized in this case. Oh my goodness, come on. And so I'm just going to put Vega no, Theta no. There may be a slight Theta. There may be a slight Vega, but it's going to be small. Okay. Okay. There, David, thank you very much for that. David is giving me a little easier way to do it than I did, but let's do this. Okay. Last one. Covered call. What's a covered call? We're buying the stock. We're selling a call. The short call is negative, but the short call has a negative delta. However, the long stock, 100 shares of a long stock is 100 delta. So actually it is a net positive delta on that trade. Okay. Time decay. There's time decay on that. The stock has no time decay, but the short option, the short call, has time decay. And so that should be a plus sign. I accidentally typed in a negative sign. And Vega, it's going to be opposite my theta on this. Benefits from a decrease in implied volatilities. There's our table right there. I want to use this here in just one sec. Okay. So if you wanted to do a screenshot, I won't stop you from doing that there. But let's just talk about it. Let me just reiterate one thing I mentioned before, and that is I'm not going to put in a formula here and it's going to tell me the exact perfect trade. But these are the general principles that we're going to be looking at here. Delta is probably numero uno, I would say, in terms of in terms of choosing our strategy. Theta, time decay, and implied volatilities can certainly affect that. Now we're heading into earnings season, so you kind of got to decide if earnings is something that you are interested in. So let's look at a couple example trades. Okay, so I'm going to go to MDT. So here is MDT. Medtronic, nice little trend up, but one thing we may consider here is things like implied volatility. So you can look at this and you can say, well, where's implied volatility doing? Where's our earning? Well, our earnings is not, earnings is not for a little while on this. We had it towards the end of May, in June, in July. Earnings is probably not going to be till August on this trade. So we've got time on this. So I'm going to go and say, let's look for a bullish trade. So delta positive. Okay, delta positive trade. I want time decay, theta, I want that to be positive too. Now, ideally, what I'd have is, usually theta positive, delta I mean, I could do a more complex trade where theta is positive and vega is positive, like a calendar spread, but that's not going to really fulfill my needs in terms of delta here. So if I could do a vega negative trade, then I have something like a short put vertical. Okay, that would kind of probably fit the bill, wouldn't it? So that it's going to kind of come down. So let's see, short put vertical, positive delta. Excuse me, short put vertical. Where's short put vertical? It's down here. Positive delta, theta positive, vega negative. This is going to be a higher probability trade here if I did a short put vertical. What about my implied volatility? Well, my implied volatility is coming down, but I need to be realistic on this. It's going to be kind of mixed because, yes, it's been coming down, which would tend to maybe support the idea of a vega negative trade, but realistically, how low is that going to go? We may be getting near the end of the road here in terms of vega. But remember this, when you're doing these, those are going to largely offset each other, those two different strikes on those options there. So I'm not going to stress over a little bit in case implied volatility switch up on me, and I'm just going to look to do that. I'm going to say we had a little bit of a breakout here around 89 or so, and I'm going to look to sell a short put vertical with the short put below the 89 level. Okay? And so let's do it. Let's go to MDT. I'm going to go out about a month here. I'll go to 35 days out. I'm going to go, and we said 89 was about we have some support there. I can go down to this 87.50. That's a 30 delta. So that's a little ways out of the money. I can sell this guy here. I can buy, I'm going to hold down my control key, this one here. And let's just kind of look at this trade. Let me confirm and send. I'm not going to send it quite yet. But let's just kind of look here on this. This is, yeah, look, our max profit is showing as $31, max loss $219. That is not looking very good. So I want to do a little reality check on this. It's only showing a 34-cent credit on this, which actually wouldn't be bad at all if the spread were $1 wide. I have a $2.50 wide spread here on this. So I'm going to say, no, I don't think so on that one. Let's look at maybe another possible variation here on this. I'm just kind of surprised that it's that way. Let me look, and I'm going to just change this up. I'm going to go out 49 days. Let's go out 28 days here on this. Okay, let's do this. We said 89. Let's go to you see here's the challenge on this trade, and I may end up skipping this trade here. This is the challenge on this. Do you see? Look at the bid price and look at the ask price. Do you see a problem on that? So when it's giving me the prices on this, and Chris pointed out something additionally, our implied volatilities are really low. For an individual stock here, that's pretty low. Now, it doesn't have earnings, but when we're looking at these individual prices and we're pulling this up, it's, unless we got filled at, prices that are maybe unrealistic prices, we risk there's going to be too much slippage in those. If you're seeing that big a difference between your bid price and your ask price, bid price, ask price, that's a non-starter for a trade typically there, okay? Pia said it's wide enough to drive a truck through. So we're going to say ixnay on the MDT short put vertical trade there. Now, these are too wide. Now I could go, if we went to the monthly options, which is where I was, you see, this was the issue. It still has big spreads. I was thinking going to the monthly option, the spread wasn't going to be so big. It's still probably too big. So I'm just going to take that off the list. We're going to move on, okay? Now, so I'm going to move on. Let's look at a different trade here. Okay. I'm going to go to Target, TGT. So here's Target. Okay. Again, we don't have earnings for a little bit here on this. I'm going to call this trend generally going up. Okay. Generally going up. I'm going to say our IV is as low as it has been. So what I'd like to see is maybe a bullish trade, positive delta. Okay. I'd like to see something that is positive vega to help on that, and something where our maybe we're a little bit more neutral in terms of our theta or minimized. And look, if we did a long call vertical, it would be a positive delta, bullish trade. Our theta is largely offset. Our vega is largely offset too, but it's not going to hurt us in any case. It's probably not, at least. So I'm going to do a long call vertical on this trade. Now, this is a less bullish trade than just doing a long call, okay? So if I'm really super bullish on this, maybe I want to go to the double plus area there, to this long call. But keep in mind, time decay would be working against us there on this. The long call vertical limits the risk. It also limits the potential gains on this, okay? So, but bullishness, I could do this. I could say, let's look at our moving averages. There's our 20-day moving average. There's our 50-day moving average. We have higher highs and higher lows. And there you go. Now, Bush asked a great question. Bush 8531 asked a great question in the chat. How big is it too big of a bid-ask spread? In general, this is kind of a generality, and everybody's going to teach it a little different. What I would say is this. If it's greater than 10%, the difference between the bid price and the ask price, it is too high, okay? Too high. If it is, ideally, we're going to shoot for 5% or less, would be my take on that. So if I had say a dollar option, what's 10% of a dollar? 10 cents. So I'd want bid price. I wouldn't want my bid price to be lower than, 90 cents. I add an extra decimal point in there. Okay. So there's that. So that's how I would kind of go through that. Seriously said 1 cent or less would be perfect. Realistically, you're not going to find that often. So, but that would be ideal, wouldn't it? Yes, it would. Absolutely. Okay. So let's do this. I'm going to do this. I'm going to say this stock, our stock's about 104, a little over 104. I'm going to do this as a long call vertical. Here's our strikes. I'm going to go kind of at the money is right there. So I'm going to buy my 100. Notice 15-cent difference between bid and ask on this, but it's a $6.75 option. Not a problem. I'm just going to click on that 675. I'm going to go out to that 110. I'm going to hold down my control key, and here we go. Now, max profit, 512, max loss, 488. Where do I want the stock to go? I want the stock to go above my higher strike. That'd be 110. Let's go back. I want the stock to go up here. Okay. Does that seem reasonable? That seems reasonable. It's not out of the question that it's going to go up there. Now, if I said 130, that would seem probably like a pretty big stretch. I'm not saying it's going to go to 110. I don't know. But if it goes up there, that's great. That's where our gains are kind of capped out. If I think it's going to go up to 130 or 120, I'd probably just do a long call in that case, right? And also, 100 is kind of the lower end of things on this. So let's do that trade here. So I'm going to do this. Now, you can look to get out at some point. We can look to get out based on the stock price. Maybe if we break down below our 20-day moving average. Our 20-day moving average, by the way, is right around 100. So I'm going to go a little bit below that. We're going to get out, maybe around 98, a couple percent below that. So this is what I'm going to do. I'm going to change this to first trigger sequential order. I'm going to right-click on this. I'm going to create an opposite order, one to get us out. I'm going to get in on this one here. And I'm just going to pull this up just to get us a little bit more likely to get filled. And in terms of getting out, I'm going to make this market GTC. I'm going to click on my gear. And we said 98, I believe, is where we were going to get out. So I'm going to say if target marks less than or equal to 98, we're exiting this trade. We confirm and send this trade. And we're going to, I'm going to throw this in my long verticals category. Send. Okay. Now, I'm running a little bit low on time here, folks. Let me just show you one other trade I was going to do. I may not go to the completion on this trade, though. We have earnings season coming up. And the earnings season kicks off with big banks. Okay, I'm going to pull up JP Morgan, which is the biggest of the big banks, basically. And here we go. So trend up is what I would say on this. What's our implied volatility? Our implied volatility isn't that high. So what often happens after earnings, if we're going to hold it through earnings, and I realize that this is kind of more speculative, holding through earnings on a shorter term trade. If you're not comfortable doing that, then you wouldn't do that. But so the worry is implied volatilities may drop significantly on that. The good news on this is implied volatilities are actually pretty low already. So although they may drop a little bit on earnings, they may not drop that much as a stock that already has high implied volatilities. In other words, the higher it is, the more likely it is probably to drop more after earnings. And so what I'm going to do is I'm going to look at a long straddle. What's a long straddle? Okay, let's look here. Let's look at a little chart. A long straddle is one where it's either very bullish or very bearish. Remember, we're buying a call and we're buying a put at the same time. Our Vega time decay, or excuse me, implied volatility, sensitivity to implied volatility, that's one of the downsides of this. It's very positive. So if implied volatilities drop after earnings, it hurts us. But it's somewhat mitigated in this case, I think, because implied volatilities are relatively low already. So although it probably will work against us a little bit, that normal real big black mark on this, real big negative mark on this would be maybe mitigated a little bit. Theta working against us on this, but this is a trade. I know it doesn't, there's no perfect trades on this, I guess is what I'm trying to say. Yes, I want something that's going to move a whole lot, but doesn't have any time decay against us. I just don't have that trade in the arsenal here on this. So we're going to do what we can. And so what I'm going to do is I'm going to do a long straddle on this, basically on earnings. This is an earnings trade. And so I'm not going to buy that much time out. Earnings are next week. I'm just going to go out a week on this, real short term. I'm going to go at the money call, close to at the money at least. Let's see, we're right. I guess 287.50 is the closest we can get to that. So I'm going to click on the 287 long call and the 287.50 long put. There's my straddle. This is a speculative trade, assuming that JP Morgan is going to move a long ways on earnings. It's going to cost me about $10. In other words, where am I going to want this stock to go? Up more than $10 or down more than $10? I'm just kind of rounding here. The stock's at 286, so I want the stock to go above 296 or below about 276 on earnings. That is where we want it to go. If it stays in the middle, that's bad news for us on that trade. So admittedly, it's a more speculative trade, but hey, that's why you have the full playbook here. There's a lot of different trades for whatever type of, whatever you're interested in here in this, in terms of this. So I'm going to put this on, and I'm going to look, by the way, to exit after earnings. We'll see how that goes. All right, everybody. I think I'm going to leave it there because I'm out of time. This is what we went through today. We kind of did the playbook, the options playbook, so to speak, in terms of pros and cons of various types of options. Look, you may not have it perfectly, you may not have the trade exactly as you wanted, but consider these things primarily as you're doing that trade. And that hopefully that helps you to select between all those different various option strategies we have. There's a survey link in the chat. We appreciate your feedback on that. Thank you, Mike, for helping me out. Thanks for each of you joining me today. Coming up at the top of the hour, we got Market Movers. I'll be doing that one as well. And Mike will be with me on that one as well, I think. So thank you so much, Mike. Thanks, everybody. Have a great rest of the day. And we'll see you all same time next week. Bye-bye.